Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So this gold bug has turned into a gold bear, at least for now. Now, I know that's probably not what you expected to hear leading off a precious metals podcast, eh? I'm supposed to be selling you gold and silver. I'm not supposed to be bearish. But even though this show is sponsored by a precious metals dealer, I'm not here to give you some kind of slick sales job. I'm not going to lie to you. My job is to report reality and to help you make good investment decisions. And right now, the reality is the bears are in control of the gold and silver market. And the reality is there is a case to be made against gold right now. And I'm going to make that case today. And I think you're going to find it's not a very good one. But before I get into all of that, I do want to take a moment and thank you for listening to the show. I say this every week, but I do sincerely mean it. I know that there is so much content out there vying for your attention, and I appreciate the fact that you spend a little bit of time with me each week. So thanks. I appreciate that. And if you would like to help out, if you like the show, other people probably will too. You can help us grow and expand the program. All you got to do is go to wherever you're listening to this show, to your podcast platform, and write us a little review. Give us those thumbs up or those stars. And share these episodes on your social media channels. That'll help us grow the show and get more listeners. But again, thank you so much. I do appreciate the fact that you are listening. So, why am I a gold bear right now? Well, as I said, if you can't beat them, join them, and bearish sentiment has taken over the markets. As one analyst put it, quote, Wall Street has thrown in the towel on gold. Now, I would argue that Wall Street has thrown in the towel while they're still dripping wet, so maybe not the best move, but that's where we are. Now, let me be clear. I'm not saying that it should throw in the towel, but that's what's happening, and I think the sentiment is going to prevail in the near term until the narrative is proven wrong. So if you're watching the gold price, you know that gold got pummeled last week and the sell-off continued into Monday morning. The yellow metal plunged below $5,000 an ounce and then fell further. In fact, gold recorded its worst week last week since 1983. And by early Monday morning, gold had been pounded down below $4,300 an ounce. We've actually tested $4,000 an ounce a couple of times. Now, this morning, we are up a little bit. The yellow metal has recovered $4,500 an ounce, but the bearish sentiment is definitely still out there. I think there's a little bit of optimism in the markets today because I think a lot of people feel like maybe there's some progress in resolving this Iran conflict. Maybe there's not, who knows, but that seems to be the sentiment today. But overall, I think there's still a lot of bearishness out there. Now, it's important to put the sell-off into some context. Pretty much everything is selling right now, right? We've seen this before. Stocks are down, treasuries are down. Most things are generally down since the war started. And it kind of appears that amid the turmoil in the markets and the uncertainty that's out there, investors are shifting to cash and kind of taking a wait-and-see position. And we kind of see this in the fact that the dollar is up right now since the war has started, at least compared to other currencies. Oh, and by the way, people are buying a lot of oil, right? Oil is kind of the dominant headline in the financial markets right now with big price swings based on the war headlines of the day. We've seen oil swinging between, $80 a barrel up above $100 a barrel, up and down, depending on the mood at the given moment. There's also significant volatility in the markets just in general, for obvious reasons, right? We're definitely in the midst of a headline-driven market right now. The problem is figuring out what headline is true and what isn't. This week, I've heard that there are talks and even a possible peace plan. The Iranians say, nah. I don't know. Nobody knows. So we're all kind of groping in the dark and speculating. It was really interesting watching the markets the other day when President Trump announced that he was going to hold off on attacking Iranian energy infrastructure. We saw stocks and oil. Well, stocks just actually exploded up on that optimism, and oil dropped. But then it's like, is that even true? We don't know, right? So it does look to me, it feels to me like the president is looking for an off-ramp, right? Regime change didn't work. Ostensibly, they've degraded Iran's military capabilities. I would presume that they've dealt with whatever worries they had about, the nuclear program. But the reality is this economy can't sustain a war for a long time. So I wouldn't be surprised if some kind of peace deal is in the works. But again, who knows? But what's the case against gold? Well, the primary factor undercutting gold right now seems to be inflation worries and the perception that the Federal Reserve will keep interest rates higher for longer. And, there's even some concern out there that the Fed will have to raise interest rates if an oil shock drives price inflation significantly higher. And of course, higher interest rates are always considered a headwind for gold because the yellow metal is a non-yielding asset. So that's it. That's why gold is selling. People are unloading their inflation hedge because they're worried about inflation. Now, I agree 100% that you should be worried about inflation. In fact, you should always be worried about inflation because the official government policy is to devalue your money by 2% every year. Now, of course, over the last several years, they've been devaluing your money much quicker than that. But 2% is the plan, right? Debasing your currency is the plan. But the mainstream isn't worried about that, right? They think that's a feature of the system and not a bug. They get all upset if there's deflation, which is absolutely insane to me. Oh no, prices are dropping. But what most people are worried about right now is an oil price shock. Right? They're calling this inflation. But as I've explained over and over again, it's not really inflation if you're not conflating a bunch of terms, right? And I'll just go over this again. I think I say this every single week, but it's one of the kind of gaps in thinking that I really hope that my work at some point can help correct a little bit. Inflation is a general rise in the price level that is caused by one thing: money creation. That's the only thing that causes all prices to rise. Inflation is an increase in the supply of money and credit. That's how it used to be defined economically. Now, of course, today we just define inflation as rising prices, but that creates a lot of confusion. Now, one symptom of monetary inflation is price inflation, right? Rising oil prices can also cause significant price inflation because, of course, energy factors into almost everything. So right now, we have pressure on prices from oil, and we also have inflationary pressures because, as I've noted on the show, the money supply is rising rapidly right now despite the myth of tight monetary policy. That's why when we get these cooler than expected CPI reports, I've been emphasizing we still have plenty of inflation. We're still creating a lot of money. That's inflation defined, and eventually that's going to find its way into consumer prices and asset prices. That's how it works. All of that said, we will likely see some very hot CPI prints in the months ahead. We saw a very hot producer price index from last month. So the mainstream's going to call that inflation, and they believe with all of their little hearts that the inflation hawks over at the Federal Reserve are going to respond with higher interest rates. If not hiking rates, at least holding rates higher for longer. And as you know, nobody wants interest rates to be higher for longer because we live in a world with a debt black hole. So on the other side of the coin, right, gold is an inflation hedge. And to me, it's a little bit odd to sell your inflation hedge as you anticipate higher inflation. However, Over the last decade or so, the anticipated trajectory of monetary policy in response to inflation has driven the gold price more than inflation expectations themselves. And this has created a world where inflation worries drive gold prices lower, and when markets expect inflation to ease, they buy gold, anticipating the Fed is going to cut rates and create more inflation. And we saw this a lot when the Fed was in the midst of its hiking cycle. Every time that we would get hot inflation news, we would see gold sell off. And every time inflation seemed to cool, gold gained, right? It's the opposite of what you would think when you're thinking about gold as an inflation hedge. That's just the way the markets have responded. The biggest driver seems to be the perception of what the Fed is going to do. Not even what the Fed is doing, what people think the Fed is going to do in the future. So now we've got this gold sell-off, and it's kind of like a rock rolling downhill. People who got into the market just chasing new daily highs broke camp. Weak hands are being filtered out, and there may well be more downside in the days and weeks ahead, especially if the central bank turns more hawkish in their rhetoric. I think that is a reasonable anticipation, and that right there is why I'm a little bit bearish. I don't think that this sentiment is going to quickly change unless we see a quick end to the war. Analyst Adrian Day has also become bearish on gold in the near term, and this is another guy who, like me, would probably be considered by most folks a gold bug. But he said, quote, "Sentiment has changed, and the market is focused on the negatives, including central banks around the world, including the Federal Reserve, being more reluctant to cut interest rates in the face of higher oil prices." So there you go. That's basically where we are right now. We live in a world where everybody's worried about what central banks are going to do. The perception of monetary policy trajectory is really kind of what's driving the markets. And I know this is confusing for a lot of folks, especially people who maybe don't follow the markets closely, and they just kind of have these kind of vague impressions on how things should be. And one of those impressions is that gold is a safe haven, and therefore, since we have a war and all of this geopolitical chaos, it should be doing well, and it's not, and that confuses people. And I've actually had people tell me, "Look, Mike, gold is broken." No, it's not, because the truth of the matter is this pattern is actually pretty familiar. Gold does not always immediately respond as a safe haven at the onset of a crisis. We saw similar dynamics to what we're seeing right now in the early days of the 2008 financial crisis and the pandemic. Now, I've already reported on the fact that the historical pattern since the 1980s suggests that beyond an initial safe haven bump, a war alone doesn't seem to significantly impact the trajectory of gold prices. As wars drag on, other factors tend to drive the markets, particularly monetary policy. That's the theme, right? So this has proved true so far in the Iran conflict. After initially surging to over $5,400 an ounce at the onset of hostilities, gold quickly corrected as worries about inflation and higher interest rates drove the price down and kind of brought us to where we are now. World Gold Council analysts say that there are several dynamics weighing on gold, led by inflation concerns. Quote, "Sharply higher real yields and expectations that policy rates will now rise in 2026, alongside deleveraging and profit taking, have all weighed on sentiment." So that's a really good summation of what's kind of happened in the gold market over the last week or two. And that brings us back to the current narrative, right? Most people believe the Fed will be forced to hold rates higher for longer to deal with an oil price shock and an inflation surge. The World Gold Council noted that, quote, "The oil market disruption and the Fed's hawkish stance further cooled investors' hopes on future cuts, pushing up yields and leading to accelerating global gold ETF outflows, mainly from U.S. funds." I will pause here to note that Asian ETFs are actually gaining gold right now. Something to think about. But more broadly speaking, despite its safe haven nature, it's not unusual to see gold fall in the early days of a crisis, as I've already alluded to. As the World Gold Council pointed out, gold plunged in the early days of the 2008 financial crisis and the pandemic. Quote, "The speed and breadth of market moves echo risk-off episodes seen in 2008 and 2020 when liquidity dynamics temporarily dominated fundamentals." Liquidity dynamics. So what does that mean? Well, what they're talking about here is worries that it may not be easy to get a loan, that money may become hard to come by in this tight, higher interest rate environment. Right? Many people forget that gold was in a bull market in early 2008, but suffered a significant sell-off at the onset of the financial crisis when the yellow metal fell 32%. It gave up about 40% of its previous bull market gain. Kind of like what we've just seen recently, right? We had this big bull market, we had a war, and then gold has given up a lot of that gain. But after that brief sell-off, gold took off and soared by over 153% over the next few years. So over the last several weeks, we've seen everything from equities to bonds to commodities selling off, right? And as I've already pointed out, it appears that many investors are moving to cash to wait out the uncertainty of the war. So when everything sells, this often triggers margin calls. It forces investors to liquidate assets to raise cash. Given gold's liquidity, it is often the first victim in a sell everything environment. And you can see this if you watch charts at the onset of a lot of crises. You'll see gold initially sell off along with everything else. Worries about higher interest rates are also intensifying concerns about overall liquidity. And I think this is key. This is an area that I think you should pay really close attention to. There's a lot of stress in the private credit market. Right? Now, when I talk about the private credit market, what I'm talking about is non-bank lenders, such as private equity firms, asset managers, and other specialty funds. These folks pool money and they loan it out. These institutions lend money directly to companies, and they provide alternative funding options for companies and also for individuals. When an economy becomes over-leveraged, too much debt, there is generally some spark that triggers a meltdown, right? In the late 1990s, it was the dot-com bubble. In 2008, it was the real estate bubble. I recently wrote about concerns that the AI bubble could cause a credit market meltdown, and this kind of gets into some of the issues that we're seeing in the private credit market. I'll link to that article on the show notes page. You can also find it over at moneymetals.com/news. So, a prolonged war may speed up that process. So in a recent interview, verified investing market strategist Gareth Soloway said that there are already, quote, severe cracks in the private credit market. He noted that several big private income funds, and these are funds that invest in this private debt, they have started gating investors. Now, what does it mean when I say they're gating investors? In effect, they are placing limits on withdrawal requests. For instance, Morgan Stanley's North Haven Private Income Fund is strictly enforcing a 5% quarterly cap. As a result, the fund only met 45.8% of its redemption requests. The fund reportedly made the move when withdrawal requests spiked to nearly 11%, made the move to start gating. On Tuesday morning, so just yesterday, Bloomberg reported that Ares Management has also limited withdrawals from its $10.7 billion credit fund. Soloway said that this stress is being reflected in the gold market as investors use the yellow metal's liquidity to cover their liabilities. So this is going exactly back to the process that I just talked about. He said, quote, all of a sudden they're down 20+% on their positions, and that can create margin calls. Soloway said those players have to be wiped out before gold resumes its north trajectory. And again, this is exactly what happened in both 2008 and 2020. Rising Treasury yields also reflect stress in the credit markets as demand for U.S. debt remains tepid. Soloway called the spiking 10-year Treasury rate a yield shock, equivalent to a 50 basis point Fed rate hike. So there is some reality in the fact that even if the Fed isn't doing anything, we are seeing a tighter lending environment, right? Because of the increase in Treasury rates. And when that happens, that ripples through the rest of the bond market and the rest of the credit market. Quote, I think the bond market is in play here and actually dictating policy, Soloway said, speculating that rising yields might have motivated President Trump to walk back strike threats. So he's saying that this economic factor is really playing into war decision-making, not an unreasonable assumption. So how all of this plays out is really going to depend on how long the war continues, right? The longer the conflict goes on, the more likely it is that we'll begin to see some of these economic bubbles pop. Now, I've mentioned this before on the show. You know, we still have all of these malinvestments in the economy that really date back to the 2008 financial crisis and the Great Recession. We had decades of loose monetary policy that creates malinvestment. It blows up bubbles, right? Which bubble pops? Which one actually causes the whole thing to start to deflate? You never know. But we never did reckon with the monetary malfeasance of the 2008 Great Recession era. Because what happened is when that started to correct, we had the pandemic, and that allowed the Federal Reserve and the government to double down on stimulus. So it injected even more liquidity into the economy, created even more inflation, created more malinvestments, and it kicked the can down the road. So we have to reckon with two bouts of monetary malfeasance now that have never been cleansed out of the economy. The economy is going to have to cleanse that out at some point, right? I don't know how far they can kick the can down the road. They've kicked it a lot farther than I thought they ever would be able to. But that's looming. And we're starting to see these cracks in the private credit market. And again, you know, I hearken back to 2008. It was credit issues in subprime mortgages that sparked the crisis in 2008. So something is going to spark this. So you'll notice that I'm talking a lot about perceptions, right? The perception is inflation is going to take off. The perception is the Fed is going to do Fed things and fight inflation. But what is the reality? Because I don't think perception and reality match up. And that's why I think that this case against gold, this high interest rate, I think it's a bad narrative. What about reality? I don't think the Fed is going to raise interest rates. I'm not even certain the Fed will hold rates higher for longer. In fact, I believe we're going to see more rate cuts much sooner than many people expect. That's because, again, this war may well be the pin that finally pops the debt-riddled bubble economy. And I don't care if there are inflation worries or not. I am almost certain, I would bet dollars to donuts that the central bank will respond to an economic crisis the same way it always has. It will slash interest rates. It will launch quantitative easing. It will print money. It will stimulate. It's going to seek to rescue the economy and worry about the inflationary effects later. It's going to be exactly like the pandemic. I remember them talking about it. Oh, yes, this is unprecedented. This is a lot of quantitative easing. This is a lot of money printing. This is a lot of stimulus, but we're in this crisis. We have to do it. We'll worry about it later. And that's exactly what they did. That's why we had the big bout of inflation after the pandemic. Right? Got to pay the piper. That's what the Fed does. This notion that it's going to pick inflation, that it's going to tamp down inflation while the economy is crumbling, I don't buy it. Now, it could happen, right? It's not out of the realm of possibility. The Fed could hold the line on inflation and say, you know what, we're going to let the economy do what it does and cleanse all of this out. I don't think it will. That is not politically viable. That's my opinion. So what we're really kind of talking about here is stagflation, right? We're talking about rising prices, rising price inflation, even as the economy is in a tailspin, even as economic growth is contracting. And we're definitely seeing a contraction in economic activity. We're already seeing it from the war. So If this war goes on very far at all, I really do think that that's what's going to tip the economy over into a recession. And that's when you're going to see extreme monetary easing, because, again, that's what the Fed does. It's the fork the Fed knows. And I've been anticipating a stagflationary scenario for a long time. The economy is set up for stagflation. We have a debt black hole and a bevy of malinvestments, again, dating back to the Great Recession years, that have never been cleansed out of the economy. And we have sticky inflation combined with monetary policy that, contrary to popular belief, remains historically loose right now. Remember, the Fed is actually running quantitative easing as we speak. You can go look at the Fed balance sheet. It's going up. It's not going up a lot. It's just a little bit. You know, they're saying that we're just keeping the pipes cleaned in the financial system. You call it what you want. It's quantitative easing. That's what they're doing. And, I've been talking about this for well over a year now. The Fed is in a catch-22. And I think this is an extremely important thing to understand when you're looking at the big picture. I believe that in the not too distant future, it will have to pick between inflation and propping up the economy. It's going to have to reckon with this catch-22. It's been walking a tightrope now for a couple of years. But it's going to have to make the choice. And when it hits that crossroad, again, I believe it will choose inflation. When the easing train starts running down the track, I want to have gold and I want to have a lot of it. So I mentioned Adrian Day, who's an analyst and also a gold bug, and he agrees that gold's downturn will likely prove, quote, temporary, and that the hawkish Fed is a myth. He said that while the central bank may not cut rates aggressively, it could launch another round of quantitative easing, noting that, quote, it would have an equally positive impact on gold. And as I've already mentioned, the Fed is in fact already running QE operations. Of course, you're never going to hear that word uttered by a central banker or a financial media pundit. In fact, they may never use the term quantitative easing again because it's just not a very popular term. But, call it what you want, right? That means that the Fed is buying treasuries with money created out of thin air. Call it what you want, right? At the end of the day, it's quantitative easing. So, I'm a gold bear right now because I think that gold bugs might have a rough time in the days and weeks ahead, because this perception is going to persist until reality takes control. But as the saying goes, this too shall pass. In fact, as quickly as the news on the war keeps changing, it could pass pretty quickly. However, until the market sentiment gets off this notion that interest rates are going to stay high or get higher, they aren't really high now, historically speaking, but gold and silver are going to continue to face headwinds. As Day notes, we need to keep focused on the big picture as we're inundated by a parade of headlines. He said, quote, and the buyers of gold the last few years and the reasons they were buying have not gone away. So we may see gold weaker in the near term, but the fundamental monetary and fiscal problems behind gold's bull market will reemerge once the war ends or settles down. In fact, I would argue that a prolonged war will actually exacerbate some of the underlying factors that have driven gold higher over the last couple of years, particularly the debasement trade. Because one of the things that is worrying the world about the dollar, one of the reasons that the world has been buying gold over the last couple of years is they're worried about the United States' fiscal malfeasance. They're worried about the debt. They're worried about the out-of-control spending. They're worried about the long-term trajectory of the dollar. So they want to have real money. They want to have gold because they're worried about this debasement. They're even calling it the debasement trade now, right? Which is kind of surprising that the mainstream is actually using that term, but it's exactly what it is. And a war is going to exacerbate the spending. I think they're asking for $200 billion for the war already. We don't have $200 billion. We just ran another massive deficit in February. I'll link to an article in the show notes page that goes over all the deficit numbers. It was like $300 billion plus. So we're going to add to that. We're going to have more spending. We're going to have more borrowing. So that's going to be more debt. Another thing that we should note is that on March 17th, the national debt squeaked up above $39 trillion. Now, you might be thinking, Mike, didn't we just have a $38 trillion just recently? Yep, in October. It just took from October to March 17th to add another $1 trillion to the national debt. It's unsustainable. It's going to keep driving the debasement trade. That's not going away. I don't care what the Fed does with interest rates. That fact alone is a good case for gold. The fact that we have this debt and we know that the only way that they can keep maintaining the borrowing and spending is through the inflation tax. They're going to keep debasing your money. So when I say I'm a gold bear for now, that doesn't mean I'm selling my gold. That seems insane to me in a world where we're likely going to face a declining economy and rising inflation. I don't want less gold. I want more of it. And that means I view these sub $5,000 an ounce prices as a nice buying opportunity. Right? In the long run, I sure as heck don't want to be sitting on a bunch of fiat dollars as the federal government continues to run massive deficits and drive the debt higher. I don't want to be sitting on a bunch of fiat dollars if the economy goes into a tailspin. And I sure as heck don't want to be sitting on a bunch of fiat dollars when the Fed cranks up the money printing machine to rescue the aforementioned economy in a tailspin. So if you're like me and you're viewing this as a good buying opportunity, you might want to head over to moneymetals.com. And if you're interested in taking advantage of the lower prices right now, we have a good deal on 1/4 ounce sovereign gold coins. It's a great way to get gold if you don't have enough money for a full ounce. They're a little bit smaller, a little bit more manageable, and they're beautiful coins. These are coins that are printed by, mints like the Canadian Mint or the Perth Mint. And it's, again, a great way to get gold if you don't have enough money to buy full ounces. And you can get more details and find some good deals on silver as well over at moneymetals.com/buy/specials. That's moneymetals.com/buy/specials. And I should note that not everybody is selling right now, right? You know who is taking advantage of lower gold prices? Asians, right? I already mentioned that according to the World Gold Council, gold is still flowing into Asian ETFs, even as it's draining out of North American funds. And I've noticed an interesting thing, just kind of watching the gold prices in the morning over the last several days. They've actually been positive when I first get up, right? As the Asian market is kind of getting toward the end of its day, gold's up. And then as soon as the U.S. market opens, that's when you start seeing gold get pounded lower. So a lot of this selling is in North America, and I would imagine probably in Europe. But Asians are still accumulating gold. I wrote an article yesterday, and you can check it out over at moneymetals.com/news about how Singapore dealers are actually stocking up on gold, anticipating higher demand. So everybody's not bearish. Asians, as is typical, they're buying gold. Before I close out, I also want to note an interesting dynamic that's happening in the silver market. While the paper-driven silver price is swinging all over the place, the Chinese have been gobbling up physical silver. Like they're getting metal. China imported 790 tons of silver through the first 2 months of 2026, with 470 tons flowing into the country in February alone. This is real silver, right? Not paper. And this is happening in a silver market that is already short on metal. The global silver market is expected to run its sixth structural deficit in 2026 as silver investment remains strong. So, you might want to look at silver too, and maybe not be quite so bearish on that either. So, that is my not so good case against gold. It's a case against gold that I think falls flat, but that is the case against gold that is driving markets right now. You can decide for yourselves whether you think that this case is good or not and act accordingly. If you are also bullish long-term, again, take advantage of gold and silver on sale. If you want real money that's going to hold value over time, call 800-800-1865. Talk to a Money Metals, precious metals specialist. They can answer questions for you. They can help you figure out how precious metals will fit into your investment strategy. If you don't like talking on the phone, you can go to moneymetals.com, chat with a precious metals specialist in a chat online. Or if you know what you want, you just want to grab some of those specials, you can do it directly from the website. We'll package it up. We'll send it out to you. Or you can store your metal in our state-of-the-art bullion depository located in beautiful Eagle, Idaho. So that is a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show today and a whole lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you join the other 1 million people that are on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you'll also be able to tune into our Market Wrap podcast that runs every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. So thanks again for listening to the show. As always, I really, really appreciate it. I hope you have a fantastic rest of your week, and I'll be back again next Wednesday.